Hello everyone, welcome to a brand new video. Today we're going to talk about real estate and tricky rental questions. So first of all, we're going to talk about multiple rentals with different owners. So this question came from one of the Facebook groups, and this was a situation where it was a preparer that had a client, and the client owned multiple rentals, and then she also had a 50% ownership in a rental with a family member. So the client had 50% ownership in one rental property and owned the other three rentals outright, 100%. The property that's 50%, the preparer was asking, how should we do this? Should we process it on a separate tax return? Does she get a Schedule K-1 or something else? She owns the property outright with her uncle. No LLC. So none of the properties were actually being held in an entity. And that actually makes things so much easier. If the real estate is not being held in an entity, if it's not being held in an LLC, and to be honest, in some states, having an LLC is a hassle. In California charges $800 for each LLC every single year that you set up. It's an annual franchise tax in California to have an LLC. I know that in some states it's cheaper. I've heard that some states are $15. I think it was Wyoming or South Dakota or something like that. That's relatively inexpensive for an LLC. California, $8 a year for each LLC, and that's an annual franchise tax. You got to pay that whether your company makes money or whether your rental makes money or not. I feel that if your franchise tax is that high, you could probably get an umbrella insurance policy and a fantastic insurance agent for a lot less than that to cover all of your assets. I mean, if you're not a multi-billionaire. I don't really understand why you would want to pay the state of California $800 every single year for every single LLC that you set up, when for the same price, probably half price, less than that, you could get an umbrella insurance policy, a fantastic insurance policy to cover yourself, to cover your tenants, to cover your rental, to cover all of your assets for less than $800 a year. And also, on top of that, have an insurance agent that you can go to if you have questions about insurance. Okay, anyway, so in this case, the taxpayer did not have an LLC. She's just holding that rental personally. If the real estate is not being held in an entity, then you don't need to worry about it. You can just split the profits and the expenses based on what each owner actually paid and or received. Depreciation would actually be split 50-50 if the ownership is 50-50. That's what it says in the pubs on each of their respective Schedule E. And basically what I do when I have a situation like this where it's 50% ownership is, if you have software that will split it for you, some software will, like Lacert will split it for you. From what I remember from Lacert, when I worked at a CPA firm in California, if you put 50% ownership, then you could put the totals in, and Lacert would split it for you. My particular software that I'm using now is TaxAct Professional. It's really inexpensive, and it also has an interview function, which is why I like it, because I have a really small practice base. I'm not telling you that you should use TaxAct Professional or Lacert or anything. I'm just telling you that I have experience with software that will split the rental activity based on the percentage of ownership. And I also currently am using a software that doesn't do the split. I mean, if it does, then I don't know how to do it in TaxAct Professional. So I just bust out a spreadsheet and I do it on the spreadsheet. Okay. And so I do it in Excel. So the depreciation is supposed to be 50-50 if you have a 50-50 ownership rental. And like I said, that's straight out of the IRS publications. And then you can split everything 50-50 if you want to make it easy, the profits and the expenses. But sometimes when you have rentals like this that are owned by family members, one family member will pay more of the expenses, or you know, they'll say, okay, I'm going to pay the trash if you take care of whatever else expense. You know, you got to replace a window. the other owner is going to do it. So sometimes you have to do like a little bit of an override on the Schedule E, but you can just deduct whatever that owner paid. Okay. So the best way to do it, in my opinion, is to just have a spreadsheet for each rental activity, and each rental should be tracked and reported separately. I think personally, it is a bad idea to group rentals. I don't like it because when you group rentals, you can make a grouping election to group the rentals together. Sometimes people will do that, but if you do that, it's an irrevocable election. If you lump all of the rentals together and group them together, then it's an irrevocable election. You can't change your mind after that. They're grouped forever until you dispose of them all. Okay, so what ends up happening when you make a grouping election for the rentals, then it's an irrevocable election, and if one gets sold, and they're grouped together, then all the losses get tied up together into that group. Okay, so if you lump 3 rentals together and you group them together, then if one of those rentals gets sold and it has losses, then those losses are tied up into that group until you sell all of them. Okay, so that's something that most people want to avoid. All right, now that's a decision that you can make with your taxpayer if you want to group your rental activity. I generally don't think it's a good idea because, like I said, it's an irrevocable election. You can't change your mind once you do it. And then any losses get tied up into that group basically forever until you dispose of all of those rentals in that group. All right. And I'm not one of those people that likes to make irrevocable elections. I like to have choices. Now, I talk about this in the PassKey books, okay? But the grouping election for a rental activity, when you group your rentals together, it's not the same thing as the grouping election that you might make with businesses for 199A purposes. So the aggregation election, where you aggregate businesses together for the QBI deduction, the qualified business income deduction, is a different election than the one that I'm talking about here. The grouping election with rentals is Section 469, and the election to aggregate businesses for 199A, the qualified business income deduction, is a different election altogether. The aggregation election for 199A, you have to make every year, and this one is not the same. The election to group your rentals all together, the Section 469 grouping election, this one is irrevocable and you don't make it every year. Okay, so it's a different election altogether. I just don't want you to be confused by that. Let's talk about depreciation on flooring. This is not something that I had a huge amount of experience with because I'm not a carpenter and I don't know very much about like different types of flooring, but you learn, right? You learn as you go along. And one of the reasons why I belong to multiple tax groups, multiple tax professional groups, is because I can learn from other professionals who are experienced in the industry. So you can learn with me today about flooring. Another tax professional asked this question once again in one of the groups about how to handle the depreciation of floating vinyl floor. So floating vinyl, I guess, is like the Pergo stuff, and it floats because you can take it back out relatively easily, right? So floating vinyl installed in a residential rental that's already been placed into service. So you have a residential rental and you already have long-term tenants in it. We're talking about a long-term rental activity that's being depreciated at 27.5 years. That's month-to-month tenants. We're not talking about a commercial rental, and we're also not talking about like a hotel or a motel. We're just talking about a regular residential rental. And the rental has already been placed into service, so it's already had tenants in it, and now they're installing a floating vinyl floor. They wanted to know if it's floating, in quotes, like Pergo, does it mean that it's not permanently attached, and depreciation, is it 27.5 years, like the rest of the rental? The total cost was $2,300. So all of this is relevant to the eventual tax treatment. And my answer was that the taxpayer has a few choices. They have multiple choices in this regard. They can treat it as 5-year property because this is actually removable. Most people don't remove pergo once it goes in, but it could be removed. So it's not like permanent flooring like tile. When you install tile, like ceramic tile, that's generally going to be depreciated over 27.5 years. Now, the reason why this taxpayer has choices is because the total cost was also under the de minimis safe harbor. Remember the de minimis safe harbor? We talked a lot about that in part 2. So they could add a de minimis safe harbor election. Now, whenever you have a de minimis safe harbor election, you have to attach a statement to your tax return when you do that. And in most software, you just check a box. Yes, I am taking the de minimis safe harbor. And when you print out that PDF of the tax return, you will see it all by itself, the little statement. It'll be usually tacked onto the back of the tax return. And it'll say, this taxpayer elects to take the de minimis safe harbor election. Okay? In my software, it's just a box that I check. Okay? And when you have a person that decides to take that de minimis safe harbor, they can choose to expense anything that's under $2,500. So they could choose to expense this amount, or they could choose to depreciate it over 5 years, since it is like a removable flooring, and they can make whatever choice gives them the best tax result. Okay, so sometimes you don't want to expense everything using the de minimis safe harbor. Sometimes you prefer to depreciate, and this is especially true if the taxpayer has losses for the year, or if they're in a lower tax bracket, but you know that they're going to be in a higher tax bracket in a future year. It's better to save those depreciation deductions for a future year. So this taxpayer has choices, all right? They can choose to take the de minimis safe harbor and expense the whole thing because it's under $2,500, or they can choose to depreciate it over 5 years because it's not a permanent installation like tile. Now, if you were to install tile, like a permanent flooring where you're putting the stucco down or whatever it's called, or the grout, then that's going to be 27.5 years, and it basically gets depreciated over the life of the rental. That's assuming that you spend less than $2,500 to install the tile. Now, tile flooring generally costs money, it's not cheap, but sometimes you'll just do one room, like maybe you'll just install tile flooring in the bathroom and it's less than $2,500. So then you can take the de minimis safe harbor election in that case too. All right. So whether or not you take the de minimis safe harbor, so it's less than $2,500, then you can expense it in the current year. All right. Okay. Depreciation on an Airbnb. How do I handle the depreciation of an Airbnb where substantial services are provided? Is it treated like a hotel? Okay, so the answer to that is generally yes, if it's a short-term rental activity where services are provided, right? So if you have an Airbnb and you're treating it like a hotel, like the IRS has given us guidance on what qualifies as substantial services. And what that means is if you're providing daily maid service, like someone's coming in to clean every single day, if you're providing like breakfast every morning, continental breakfast, or, eggs and bacon or whatever, that's also substantial services. Fresh towels every day, that sort of thing. Then that would be treated like a hotel or a motel activity. That gets reported like a commercial rental, and it's depreciated over 39 years, right? So you got to remember this for the EA exam too. And just in your own practice, this is a question that's going to come up over and over and over again. Okay, so commercial rentals are 39 years. So this would be something like an office building, right? A factory, that sort of thing. That's 39 years, okay? And then 27.5 years is when you have long-term tenants that are month to month, 27.5 years. Now, remember, one big advantage that 39-year property has over 27.5-year property is that you get Section 179 expensing and bonus sometimes, depending on the situation, while residential rentals do not permit this. Now, let's talk about some examples of this, because I know people always want examples. Section 179 can apply to certain lodging facilities and commercial facilities. Now, notice I say lodging, and I'm not saying residential rentals, because Section 179 does not apply to residential rentals. But it can apply in some situations to facilities where people are actually sleeping in them, just not residential rentals. So let me explain this. Section 179, qualified real property, only applies to certain types of improvements. It includes roofs, HVAC, which is like heating and air conditioning, security systems, fire protection. So we're talking about like sprinklers, you know, the things from the roof, those little metal things, they come down if there's a fire protection, and alarm systems in non-residential buildings. And if you ask me, why is it this list and not some other stuff? And it's just because Congress decided these are the improvements that are going to qualify. I didn't make these choices. This is what's in the code. All right. So roofs, HVAC, security systems, fire protection, and alarms. Okay. In non-residential buildings. So a commercial building's new roof for Section 179, but it's still considered 39-year property. Do you understand that? So if you have a commercial building and you replace the roof, a commercial building would be like an office building, right? Like a medical office building or something like that, a warehouse. That's not a residential rental. If you replace the roof, a new roof, you could potentially take Section 179 and it's still considered 39-year property. So you get to choose. Am I going to take Section 179 for this? Because a new roof is not going to be, a new roof is not going to qualify under the de minimis safe harbor, right? We've talked about the de minimis safe harbor, but I don't think you're ever going to be able to put a new roof on a house for less than $2,500. Okay, so roofs are like $15,000 and up, right? Okay, so I've never seen a roof for like $2,000. It doesn't happen. So a roof, you're going to be choosing between Section 179, or you can depreciate it over 39 years. Okay, those are going to be your two choices if you have a commercial building. Now, what qualifies as a commercial building in this case? A commercial building can be a non-residential building like a medical office building or something like that, but it can also include some types of lodging facilities, but not residential rentals. Examples would be hotels and motels, dormitories, hostels, drug treatment centers, and other types of transient type rentals like that. Okay, we're not talking about residential rentals. Of course, if you have something like a drug treatment center or an inpatient hospital center, people are sleeping there, but you understand the difference between that and a residential rental where you just have month-to-month tenants in there, right? Okay. And then number two, it would also include certain commercial facilities that are part of a lodging complex, but open to the public, such as a mixed-use building. And I had to look this up because in the pubs, it just says commercial facilities that are part of a lodging complex. And I'm thinking, are they talking about like a roller rink or something? No. I looked this up, and it is something like an apartment complex where it's a mixed-use building where maybe you have a gas station or restaurant below it. Then the commercial portion can claim Section 179 if it applies. So for example, let's say you have a mixed-use building and you have like 2 apartments at the top, and then you have like a gas station or a restaurant in the bottom. If the restaurant gets an alarm system, then that can qualify for Section 179. Does that make sense? Because the commercial portion can qualify for this special rule. All right? Okay. Now let's go to publication 527. This is the IRS publication that's just dedicated to rental activities. There's a lot of really good information in this publication. I know that Most people don't want to read IRS publications because it's not like it's reading a novel. It's pretty boring reading. But most of the questions that you will have about residential rental activities, you're going to find the answers here. Now, one of the other questions that I receive a lot is, what is a residential rental? How do you classify a residential rental when something is a mixed use building? Mixed use means you have residential rentals, but you also have business offices or like some kind of a commercial rental in the same building. Now, this is a really common type of thing, really common type of building that you'll see like in old towns. Like when I lived in Sacramento, which is the capital of California, the state capital, there was an old town. There's an old town, Sacramento, and people used to go there, and there was like little candy shops and bars and restaurants and all kinds of things, because in the olden days, there wasn't all of this weird zoning now, where you would just have like commercial buildings in one part of town and then like huge tracts of suburbs in another part of town. Back in the olden days, it used to be that you would have houses and then people would have like their businesses on the bottom. And that's not something that's commonplace nowadays, but older buildings will still have that. So if you go into Old Town Sacramento or any kind of old town, if you have an old town in your city, then you will see mixed use buildings. And this is when you have a building structure where a dwelling unit or apartment houses or apartments are usually at the top. And then you'll have some kind of a business like a Starbucks or retail stores or whatever on the bottom. Okay. Now, the very hard definition based on a percentage of when a residential rental property gets treated as a residential rental versus a commercial rental, and it's 80%. Okay. That's where you treat it as a residential rental property, and you're going to depreciate it over 27.5 years. If you have a building and 80% of the income that's coming in on that building is from dwelling units, then you treat it as a residential rental and you depreciate the whole thing over 27.5 years. If 80% of the revenues that are coming in are from the residential rental portion. Okay, it's not square footage, it's based on revenue. So if 80% of the revenue is from the residential dwelling units, then you treat it as residential. Now, non-residential real property is everything else that's being rented. Okay, this would include an office building, a store, a warehouse. You know, you can own an office building and you rent it. It's still considered a passive rental activity in that case, but it's not depreciated over 27.5 years. It's depreciated over 39 years because it's not a dwelling unit. If you're renting out a factory or an office building, like a medical office building to doctors and stuff, nobody's sleeping there, okay? And that also includes something like stores or whatever, where they're tenants, but they're not sleeping there month to month, and it's not a long-term tenancy. Now, hotels and motels, even though people are sleeping there, is also going to be considered non-residential real property because they're considered short-term rentals where substantial services are being provided. Where maid service, you're washing the sheets every day, that sort of thing. Okay. We get into a nebulous area where it's an Airbnb. And a lot of people ask, when do you put it on a Schedule C? When do you put it on a Schedule E? When does it get subject to self-employment tax? When is it going to be treated as a hotel? And when is it not going to be treated as a hotel? Okay. Now, I want you to understand that this is not like a bright line test. This is a nebulous area of the code. And we don't have a whole lot of guidance out there. And the guidance that we do have is very recent. Okay. And when you ask tax professionals about this, the answers that you're going to get many times are all over the place. But we do have a chief counsel advice now that came out in 2021, and I have a link to it. And Tom Gorzinski, who is one of the co-authors on the PassKey books, also did a great analysis of this issue on his blog, which I do recommend subscribing to. He does talk a lot about topics that you are going to see as a tax professional each and every day. You know, he talks about gambling income and the session method and how to treat rental activities, all that sort of thing. So I have a link to this particular blog where he talks about Airbnb rentals specifically. And I'm going to go over the chief counsel advice with you briefly so that you can kind of understand it a little bit better in your mind. Because I feel like this is a question that's going to continue to come up more and more and more as more and more people rent out their homes and their granny cottages or part of their homes on Airbnb. And you got to know how to deal with it. Now, let me take you to Tom Talks Taxes, which is Tom's blog. I feel like he explains this chief counsel advice in regular layman's terms, so it makes it easy to understand. So here is the blog. When is short-term rental income subject to self-employment tax? So he discusses the examples that are in that chief counsel advice. And basically the deciding factor in both of the examples is whether or not substantial services are provided to the tenant. And by substantial services, we're talking about daily maid service, breakfast, clean towels every day, vouchers to the pool, if it's a vacation rental, that sort of thing. Those are the examples that are in the chief counsel advice. One is they're both short-term rentals, right? They're both short-term rentals, but in one rental example, they're being provided, the tenants are being provided substantial services. And in the other short-term rental, there's no substantial services and it's just cleaning in between tenants. So there's not going to be towels provided every day or maid service every day or breakfast every day, that sort of thing. And that's the deciding factor, according to the IRS and the chief counsel advice. So if you look right here, it says the IRS provides two useful examples. In the first example, the taxpayer, this is the landlord, all right? The landlord or the owner of the rental is providing linens. They're talking about sheets, right? Clean sheets and pillowcases, that sort of thing. Kitchen utensils and all other items to make the vacation properly habitable for each occupant. In addition, the landlord is providing daily maid service, cleaning every day, including delivery of individual use toiletries, like those little shampoos and soaps and everything, the stuff that everybody steals from the hotels when you go, those little shampoos and the little conditioners and stuff, access to dedicated Wi-Fi, access to the beach and recreational equipment, pool noodles and those, inflatables or whatever. The IRS is telling you this is what we consider to be substantial services. If you're providing this to your tenant, then that's a situation where self-employment tax, and this is treated like a hotel or a motel activity. If you're renting an Airbnb and you're doing short-term rentals and you're providing these services to your tenant on a daily basis. Now, the second example that's in the chief counsel advice, it's also a short-term rental. It's a rental activity. It's a fully furnished room and bathroom in a dwelling via an online rental marketplace. So they're talking about Airbnb once again, or FlipKey or whatever. Occupants only have access to the common areas of the home. The taxpayer cleans the room and the bathroom between each occupant's stay, but not daily. And they don't offer breakfast or any of that other stuff. In this case, in example number 2, the IRS has stated that this particular rental activity is not subject to self-employment tax. So you would put this on the E, the Schedule E, and the first one, you would put it on the Schedule C. Okay? That's the way I would do it. Okay, that's my reading of it. So in scenario 1, the IRS opined, their opinion was that the net rental income is subject to self-employment tax because the taxpayer is providing substantial services beyond those required to maintain the space in a condition suitable for occupancy. In scenario number 2, the IRS opines that the net rental income is not subject to self-employment tax because the taxpayer does not provide substantial services beyond those required to maintain the space in a condition suitable for occupancy. So the IRS is giving you 2 examples. Both of them are like online rentals like Airbnb or PassKey. One of them, they're providing substantial services, daily maid service, fresh towels every day, breakfast, that sort of thing. And in the other one, the landlord is not providing those services. So they're only cleaning the unit in between occupants, and that's it. Okay? All right, so those are your two considerations. And this is a situation where you're going to have to decide how it's going to be reported based on the interview that you have with your client. Now, I want you to understand this. Sometimes the rental use will change mid-year or will change from year to year. And if you have it as a long-term rental in a prior year, that doesn't mean that you have to amend or anything else like that. Rentals can change from one year to the next. Okay. Sometimes you'll even have a residential rental that will be converted to a business rental. And I've seen that happen in bigger cities actually pretty frequently, where you'll have a residential rental activity and it'll be kind of on a major street, like a main street in the middle of town, and it'll be residential tenants. And then the next year, the landlord will say, well, maybe I could convert this to an office, and it'll still be a house, but then it'll be like an accountant's, and it won't be a residential rental anymore. And the accountant will be doing business out of that house because it's on a main street. The first job that I got working for a CPA office, once I was no longer a temp, I worked for a temp service first. And I was working for a CPA office, was out of a house like that. It was like on a major street in Roseville, California, which is in Northern California. And I worked for him for a tax season. And I was doing some of the easier tax returns. And it was a house, but it was converted to like a CPA office. So you can have a situation where a residential rental actually becomes like a business rental, where there's no people sleeping in anymore because of the location, right? So sometimes it'll be more profitable to treat it as a commercial rental in that case. And then in that case, that means that you would convert it either from one year to the next or in the next year. And in the past, it was a 27.5 year depreciation. And now moving forward, it's going to be a 39-year depreciation. Does that make sense? So sometimes that'll happen, and vice versa. It'll be a commercial rental one year, and then it will be a residential rental in the following year. So sometimes that'll happen. Okay? Okay. So I have links to both of these resources, actually the Chief Counsel advice and Tom's blog. Both of the links are on your slide. And I suggest checking both of those out if you have a situation like this and you want to know how to treat it on the taxpayer's return. Let's talk about gifting a rental property. Sometimes parents will gift a rental property to their kids. I have some pretty strong opinions about that. I think it's a mistake to do this. Sometimes parents, because they want like a peace of mind that the rental is going to go to the person that they want it to go to, they want to do it while they're alive. If you do this, then you lose the step up that you would receive from the decedent's estate, right? So if a rental property is owned by your parents, for example, and then they pass away, then you get a step up in basis, which means you're allowed to take fair market value on the date of their death. If you gift a rental property, that's different. A gift is not an inheritance. For an inheritance to happen, somebody has to die. When you gift rental property, then the basis is transferred. You know, we talk about gifted property as being the worst of both worlds because the basis is transferred, and if the owner has suspended losses, then it's not treated as a sale. Okay, they don't get to take those losses if you're gifting a rental property to a family member. These are the rules for related party transactions, right? This is all intermingled. Okay, so in this case, the father owns a rental condo. It has suspended losses that he can't take. Okay, so he's had losses on this rental and they're suspended, presumably because his income's too high, right? So if you have a passive rental activity and it has losses, and the person is making more than $100,000 a year, that's their HEI, then it starts to be phased out. At $150,000, then the losses are completely phased out. So the beginning of the phase out range starts at 100,000 in AGI, and you're completely phased out by 150,000 in AGI. You can't take your losses anymore. They don't get lost, but you have to carry them forward, all right, to the period of time in the future that rental actually starts generating income, or you have some other kind of passive income coming in from something else, or you dispose of the activity. Then you could take those losses. But in this case, the father disposed of the activity by giving it to his daughter, which means he's not allowed to take the losses because it's not a true disposal. He's just like transferring it to a family member. So he gives the rental to his daughter, who continues to rent it out. She gets his adjusted basis in the property, which was quite low at this point. What happens to the suspended losses? He can't recognize them because he hasn't disposed of the property in a fully taxable transaction, right? What we talk about as accountants, when we talk about fully taxable transactions, means we are selling to a stranger. If you are selling a property or giving it to a family member, remember, related party transaction rules, so to a spouse, a child, a grandchild, a parent, then those are all related parties. That's not a fully taxable transaction. The person was asking the question from the preparer, are they just lost, or do they transfer to the daughter along with the property? Assume gift tax return was property filed and no gift tax was due, okay? Now here's the answer. In the situations of a gift, we're not talking about inheritance, right? The parent is alive, giving this rental property to the child. In situations of a gift, the suspended losses are added to the basis immediately prior to the transfer. So the daughter's basis is the dad's adjusted basis plus his unused suspended losses. And this is IRC section 469J6. Okay, so this is the special rule for gifts. In the case of a disposition, any interest in a passive activity by gift, the basis of such interest immediately before the transfer shall be increased by the amount of any passive activity losses allocatable to such interest with respect to which a deduction has not been allowed by reason of subsection A, and A, such losses shall not be allowable as a deduction for any taxable year. Basically what this means is that he doesn't get to take the losses. They transfer to her, and it would be the same if it was a situation where the father had stock. And we have examples of this in the book as well. So if the father had stock, a lot of parents like to transfer stock to their kids too. And if the stock has losses, then they don't get to take those losses. The losses get suspended and then they're transferred to the child along with the stock. Now, if the child sells that stock to an unrelated party, then at that point, they can claim the losses, okay? My opinion, personally, is that you should sell the stock to an unrelated party. Most people sell their stock through their brokerage account or their cryptocurrency account like Coinbase. Just sell it and then take the money, give it to your kid, give your kid the cash, and tell your kid to buy the stock or help him buy the stock. Then you get to take the losses and then you're just giving the kid cash instead of giving the kid the stock, instead of transferring the stock to them. So that way you get to actually take those losses. But many times what happens is the parents will come in and they've already done this thing. You get to hear about it after the fact as the preparer. So you got to deal with what you got rather than giving them advice that would help them before they do this stupid thing. They've already done it. So now you have to report it as they've done it rather than telling them, don't do it this way. Take the losses this way. So many times you got to deal with it after the fact. But this is how you do it when it's a gifting of a rental property with suspended losses. Okay? Okay. Okay, death of an owner in a community property state. So now we're talking about a married couple. Okay? In this case, you have a situation where it's a rental property. So this is not their main home. Okay, this is a rental property, so it's business property. And it's a married couple, and the husband died. So the rental property was sold by the wife within 6 months of the death of the spouse. The title was held as community property with rights of survivorship. Do I wipe out the prior depreciation? How would I do that? How do I step up basis on the depreciation? Now, community property in a community property state is weird. It's treated differently. The step up is treated differently than non-community property states. There's 9 community property states currently. California and Texas are the 2 big ones. And then there's Nevada is another one. I don't know all of them off the top of my head, but the list is in your book. But Texas, Nevada, California, those are the 3 big ones. Those are all community property states. If you have a situation where one spouse dies and they own property like stock or rentals or even a main home, what ends up happening in a community property state is the survivor gets a full step up to fair market value on the date of death. So the whole property gets a step up in a community property state. In a non-community property state, only the decedent's half gets a step up, and then the survivor's half doesn't get a step up. So then you got to do the complicated math in that case. Now, if you have a situation where it is a community property state, I think in this example, it was Texas. Okay, Texas is community property state, and it's also a common law state. So in that case, the survivor gets a full step up to fair market value on the date of death. The old asset gets placed out of service, and sometimes you got to force this in your software. So they're out of service as of the date of death. So in your software, if it's a situation where the spouse dies like in the middle of the year, then you take it out of service. And it's not really out of service. I want you to understand this. This is a fiction that you are doing in your software in order to make it work so that the numbers are correct. You take it out of service in your software, and the date that it's out of service is the date that the spouse died, okay? And then the new asset gets entered in, and you start all over with the depreciation with a stepped up basis. So most of the time you've got to do this on a spreadsheet, and you give it to the, you give it to the client so they can see what you're doing. And you also have to explain it because the taxpayers don't know how any of this works 99% of the time, unless you're talking to somebody who's an attorney or, some other kind of accounting professional. They don't understand how any of this works. So you take the old asset out of service, then the new asset, which is the same old rental, you gets a step up in basis, full step up. So whatever you have for the basis in the software in the past doesn't matter anymore. It's whatever the fair market value is on the date of death of the decedent. In this case, it was the husband. So whatever the fair market value was on the date of death. And if it's a lot of money, if you're talking about an expensive rental, like something that's worth $350,000 or $400,000, it might be a good idea to invest in an appraisal, a formal appraisal, so you can get the actual value on the date of death, especially if you're not going to plan on selling it. You step up the basis in your software, and how you do it in your own software depends on your own personal preference. So in my example, I've worked at firms where you create basically a new asset in your software on the date of the death of the decedent. So for example, you do like building X step up 6/28/2022, and then you use the date of the step up as the date of death, basically when you enter in the new asset. So when the new starting date and the amount, and then of course there's going to be land value if it's a house. I know that sometimes there's rare instances where you're not going to have a land value if it's a condo. There are some states and some areas where there's no land value for the condo. When I was in California, there's always a land value for the condos. In Northern California, where I was originally practicing, and then in Nevada, where I'm practicing now, most of the time I will see like a small land value for condos. But there are some places where there's no land value if it's condo. Most of the time you're going to have a land value, so you got to break that out, because remember, land is never depreciated, so that's how you track the land portion. So you take the old asset out of service, you put the step up in the land and the building, because both of them are going to get a step up, okay, on the date of death. And you also need to prorate the depreciation based on the date of death to override for the old item that you're retiring. Basically, if you've never done this before, ask another tax professional to show you how they've done it on a tax return in the past. Once you see it once, you'll know how to do it forever. It's not that difficult, but you just need to see it on the depreciation schedule so you can see how it works. But everything gets a step up if it's a community property state and one spouse dies. All of their assets get the step up. But on a rental, this is how you do it. Okay? All right. Partial rental sale with Section 121. Now, there's tons of examples of this in the pubs. But, you know, sometimes you'll have a house where somebody is renting out a portion of the house. They're just renting out 1 bedroom or 2 bedrooms. Or sometimes easier situation is where it's like a duplex and the owner is living in one side and renting out the other side. It's all the same deal. You're going to get Section 121 on part of the property, and the other part of the property is going to be treated as a rental or a business property. So you got to do the proration, you got to do the percentage, you got to break out the spreadsheet in order to get the math right. So in this question, the client inherited a large home in the year 2000. So over 20 years ago. And this is really common in high rental areas like the Bay Area, San Francisco, San Diego, New York. People will have a house and they'll rent out bedrooms because you can make a lot of money doing that. So she rented out 2/3 of the house or the bedrooms for most of her ownership period. I understand that the Section 121 exclusion does not apply to the rental units, as it applied ratably. In this case, the full Section 121 exclusion they qualify for is applied to the portion of the gain attributed to the sale of the personal residence. So I want you to understand that the exclusion itself, that $250,000, in this case, it was a single woman. So she's not going to get the $500,000 Section 121 exclusion that applies to married couples. Remember, married couples get $500,000, and she's owned this house for over 20 years. So she's going to get the full exclusion. She's going to get the full $250,000 exclusion, but that's going to be applied only to the portion of the gain attributed to the sale of the personal residence. She's still going to get the full $250,000, but only for the portion of the gain that's attributed to the personal residence. So you're going to be treating sales. That's how you do it. You set up a sale as if it's a residence, and then you set up the sale for the rental. You treat it like they sold 2 separate houses in the same year. Basically, that's how you do it. And that's how I've always done it. You set up a spreadsheet and just do the math. And it's similar to like where you have a duplex where one side is owner occupied and the other side isn't. Okay? And the way to do this correctly is you find out how much of the property was actually rented and how much of it was just personal residence. And in that case, you're going to have to tell the owner, go in there and, you know, do it with a measuring tape. Find out exactly what the square footage of the house is versus the portion that was rented. And it is a lot easier, to be honest, if it's just a duplex, because you know that full half, you know, you can get it down to the exact square foot, the exact square footage that the rental property portion is. So that's a lot easier. Sometimes it gets a little messier when it's just a house and they're renting bedrooms, but that's how you do it. You set it up as 2 separate sales, house 1, house 2. House 1 is going to be the personal residence, even though it's all the same house. Okay, you got to set it up as 2 separate sales. And then you apply the Section 121 exclusion to the portion or to the square footage that's the house. And then the rest of the sale price, you allocate to the rental portion. Okay, and she's still going to get long-term capital gains treatment because she's owned the house for 20 years. She's going to get long-term capital gains treatment on the rental property portion. But remember, she's probably going to have recapture too because she's been depreciating the rental portion as well, hopefully. Okay. So that's how you do it. Now, sale to a spouse. Okay. This is a situation where it was another tax professional who had a husband and wife that have been separated for over 10 years, but never divorced, and they still filed jointly. So this is something that you see every now and then. I have at least one married couple in my client base like this as well. They're married and they've been physically separated, not legally separated, but physically separated for over 20 years. They live in separate households. They've never filed for divorce, or anything like that for religious reasons, but they live separate lives, and there's no community property in that case, because in California, where they're domiciled, community property ends when you have a physical separation. Okay, not every state is like this. Texas is not like this. But in California, where they are located, community property ends on the date of the physical separation. But in this case, this is an example where the tax practitioner has a situation where the wife is selling a property on installment to the husband, and it's to be paid off at least 1 year until he can finance the property on his own. She owns this house. Okay, it's a second home or whatever, presumably, and he wants to buy it, but they're married. Does it need to be fair market value when it's sold? They consulted with their attorney. Do they have to have it in an LLC? How should this be reported? The answer is you don't report it. They're married. This is not a taxable transaction. When you have a married couple, okay, they're married. They're still legally married. They've never been divorced. They still file jointly. It's basically like a gift. They're giving stuff back and forth to each other. And gifts between spouses are not reportable. If they're both U.S. citizens, this is not a taxable event for either party. It doesn't matter. They're still married. They're still legally married. They've been filing jointly. And the tax preparer wants to do some kind of a cockamamie scheme where they're, it's an installment sale and one has to recognize gain. And no, you don't have to do any of that. Okay, they're still married. Married couples can gift assets back and forth with no gift tax implications. You don't have to report anything if they're U.S. citizens. So do they trust each other? That's the only question you have to ask. She could just quit claim to him and they can have a personal note for the amounts. Why turn a completely non-taxable event into a taxable one? There's no installment sale here. I mean, there might be. If they were strangers, it would be. If they were boyfriend and girlfriend, it would be. But they're married. They're considered related parties. So this is not a sale. Okay? It's a gift, really, because they're current spouses. If she was selling it to him at a loss, she wouldn't be able to take that loss. So the spouses can't recognize the loss regardless of how they file, if it was a loss. So why should she recognize gain? Why should she treat it as a taxable installment sale? Just give him the thing. He gives her the money, and that's it. They're gifting assets back and forth the way married couples do. All right? Okay. That's it. There's no real sale here. You should not complicate this by doing an MFS return and blah, 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 blah. If they're still trusting each other enough to file jointly, then they should just treat it as a gift back and forth between spouses. And that's it. Entity comparisons. So a lot of times newer preparers will ask, can you recommend a tool or a diagram to share with clients that shows the pros and cons for real estate ownership by entity type? And no, there's no pros and cons except keep your real estate out of a corporation because it's always a mistake. Do not put real estate in a corporation unless you're just doing flips. Do not put appreciating real estate in a corporation, period. Unless you're Coke or Ford or some huge company, do not do it. There's no good reason to put real estate into a corporation, ever, okay? Unless you're a huge company or unless you're doing flips. Because in that case, then if it's flips, then real estate is just inventory anyway, and it gets treated just like any other inventory, okay? So the default for rentals is not a corporation. There are no tax pros. There's no, when you're talking about pros and cons, there's no pros to putting appreciating assets in a corporation. There's no pros. Sometimes there's legal reasons for doing it, especially with big companies like, of course, Ford and Coca-Cola and Disney, those Nike, those huge corporations, of course they own real estate. But if you're just talking about some small company like my corporation or your corporation or a husband and wife or two spouses, there's no pros to putting real estate in a corporation. So I don't have a diagram or a tool that will tell you the pros and cons because none of that doesn't exist. Okay, if you have a small company, It's generally a really bad idea to put real estate into any kind of a corporation. Okay, so unless they're flippers or land developers and the real estate is actually treated as an inventory, there's almost no good reason to put real estate into a corp, period. And the reason why that is because when you put appreciating property into a corporation and then it later gets distributed, it gets distributed at fair market value and it's treated as a sale to the shareholders, so it's generally a huge mistake. Okay? When you have a partnership, it's not treated as a sale. When you have a sole proprietorship or just a single owner, it doesn't get treated as a sale. You get to distribute that property not at the fair market value, but at the adjusted basis, which is what you want. It's not a taxable event. With a corporation, you distribute property, it's a taxable event. Okay, so you want to try to keep any kind of appreciating property out of a corporation. Most of the time, when it's appreciating property, we're talking about real estate. Okay, so that's why nobody quibbles when you buy something like a computer or a vehicle with your corporation. Because vehicles and computers and electronics, what happens to those assets over time? They lose value, right? Your computer is not going to be worth more 5 years down the road. 5 years down the road, your computer is going to be ready for the trash can, right? Because it's still going to be running Windows 7 or something like that, and you can't upgrade anymore. So it doesn't increase in value, but real estate does. Real estate, land, sometimes intangibles like patents, copyrights, that sort of thing. You want to try to keep those out of a corporation if you can help it. Okay, so I'm never going to give you a tool or a diagram that's going to tell you the pros and cons of putting real estate in a corporation, because it's all one big con. Okay, you want to try to avoid it unless it's a real estate developer or a flipper. Then actually it is a good idea to maybe put real estate in a corp. You can kind of crunch the numbers in that case, and sometimes there is good reasons because the real estate is just inventory anyway. But you don't want to put rentals into a corp. Okay? In general. It's a mistake. Okay, premarital property and divorce. So premarital property is generally considered separate property for whatever spouse owns it. So in this case, the client, it's a woman, she owns a rental property in her name only. This is something that she owned before the marriage. She either inherited it or she purchased it herself before the marriage. She got married in 2020, but kept the property solely in her name. So it's separate property to her. And this is true even if you're in a community property state. So this is property that was acquired before the marriage. It was in her name only. And even after her marriage to her spouse, she decided to keep the property solely in her name. She filed a joint return with a husband, and due to AGI, right, once you get over 100,000, that's when the losses start to phase out when you have a rental property, a passive rental property. So when we're talking about due to AGI, we're talking about adjusted gross income was too high, and the PAL was suspended. PAL means passive activity losses, which means this is a passive activity rental, okay? And she was reported on Schedule E. She has losses, and they're suspended because of her AGI was too high. That was 2020. She filed jointly with him. In 2021, he disappears and files for divorce. So the divorce has already been filed. In 2021, that's when it occurred. It's not going to be final until late 2022. He has not talked to her at all since then, so most likely she will file MFS. So this is a little bit of a messy scenario, but she's trying to get advice from her tax professional, and this is the person that posted this in the group, was the tax pro, asking what should we do? So married in 2020, filed a joint return with the husband in 2020, had a passive activity loss which was suspended in 2020, had to be carried forward. So that return was done right because they were married at that time. In 2021, he disappears and files for divorce. Okay, it's not going to be final in 2020 until 2022. So she's going to likely be MFS in 2021 because they're going to be married through all of 2021. Now, a couple of questions. Since the property was in her name only, does she get the full passive activity loss carried forward from 2020 to 2021. They do not live in a community property state. Second question, she will most likely have another loss in 2021 on the same rental, but I know that MFS means that she can't take the loss, which is not correct. That's not true all of the time, but that's what this professional thought. So is the 2021 loss gone forever, or does it get carried forward to 2022 and possibly used when she is finally signal? Okay, so there's a lot to unpack here, but I want you to understand that when you are married and you have losses, those losses, if it's your separate property, those losses, number one, stay with you. And even if you're filing a joint return, they're carrying forward, but they continue to stay with you if you get separated or divorced afterwards, if it's your property. Okay, so those losses are hers, and they get transferred to her after the divorce, right? Presumably she's still going through it, but those are her losses, they're not his. Now, it was reported on their joint return because remember, on a joint return, you combine all your income and you also combine any of your losses together on a joint filing. But now she's going to be divorced. So those losses move back over to her. Okay, they're not his. They never were his. The reason why they were reported on a joint return is because they were combining their joint income and losses on that joint return. But it's not a joint property. Okay, he doesn't own it. And she's going to continue to own it solely by herself moving forward. Okay, it was premarital property. It never was, his name was never added to the deed. And then now they're divorcing. So the losses and the property are going to continue to be reported on her return solely. Okay. They could potentially file jointly in 2021 because they're still married in 2021, but apparently he disappeared and they're not talking. So probably it's going to be MFS. So there are some things to consider, and the way it's going to be reported in 2021 depends on the scenario, and the tax preparer is going to have to ask her probing questions that are probably going to make her uncomfortable, but you got to ask these questions when it's a divorce situation like this. So if he filed for divorce and they are legally separated under state law, they might be considered single rather than married for tax purposes. So you got to nail that down first, okay? And that depends on the state. If he filed for divorce and they are legally separated under state law, they might be considered single rather than married for tax purposes. Number two, her suspended losses that carried forward would be hers. And since it is a premarital asset, it is her property and the losses are also hers. The property is also hers, and any losses that existed that were suspended are going to carry over onto her tax return. She may be able to take the losses even if she is MFS if they did not live together in 2021. The losses would be limited to half of the 25K loss limit, and her AGI would have to be less than the phase-out range of 50,000 for MFS filers. Okay, so if you live with your spouse and you're MFS and you have a passive activity loss, you don't get to take it if you live with your spouse. But if you live apart from your spouse for the entire taxable year, even if you're MFS, sometimes they can still take the losses. But all of the thresholds are cut in half in that case. So if she's MFS and she lived apart from her spouse, then you get half of that 25K loss limit, and you also get half of the AGI limit, which is 50,000. And I have an extended example in the crossover videos folder that covers rental and royalty income. Okay, so I'm not going to go over another example in this webinar because this is a bonus video. Okay, so just because you're MFS doesn't necessarily mean you can't take those losses. It just means that if you have to live apart from your spouse in order to take those losses. And if you do take the losses, then you get half of the AGI limit and half of the 25K loss limit. That's the most you could take. And then number 4, if she cannot take any losses because she did live with her spouse in 2021, you don't lose the losses. They're just carried over again and suspended until she's either under the phase-out limits or she disposes of the property in a fully taxable sale. Okay, so she doesn't lose anything. The losses don't get lost. They just get carried over. Okay. And then presumably the divorce will be final, in 2022. And then when the divorce is final, then she's single and she's back into the 100K loss limit, and she doesn't have to worry about any of these disallowances because she's MFS or anything else like that. Okay? Okay. All right. Let's talk about real estate professionals now. In this case, we have a tax professional where the taxpayer's Schedule E rental has a $13,000 loss that is unallowed based on their $175,000 joint AGI. So they have a loss in their rental real estate activity. They cannot take that loss because their AGI is too high. It's over 150,000, which is where you're phased out. They call it phased out completely. They can't take any of the losses. The clients are trying to argue that they passed the material participation test and should be able to deduct the loss. They each have full-time jobs. Now, we've talked about this in the rental chapter. Material participation and active participation are not the same thing. They use a management company to handle the rentals, but the husband generally handles the repairs, for which they believe is what gives them material participation. For someone to qualify as a real estate professional, I want you to understand that they do not necessarily have to have any kind of a real estate license. They don't have to be a broker or anything like that. For IRS purposes, they have to meet two tests. Okay, this is where they would be able to take the loss, even though they had this higher AGI. They have to pass two tests. More than one half of the personal services that the taxpayer performs in trades or business during the tax year are in real property trades or businesses in which the taxpayer materially participates, and they have to meet both of these. So, and the hours spent providing personal services in real property trades or businesses in which the taxpayer materially participates total more than 750 hours during the tax year. Okay, these people have full-time jobs and they want to be able to prove that they're also real estate professionals at the same time. That is not going to happen. What's going to happen is they're going to get audited over $13,000 in losses, which is not worth it. Like I said, you don't have to be a realtor, a real estate agent, or a real estate broker or anything like that. I mean, that helps your argument if you do go under audit. But to meet these tests, to be a real estate professional where your losses are not limited, you have to have at least 750 hours of material participation in real property, trades, or businesses. That doesn't just mean rentals. It means you could have a flipper going on. You could be doing a flip. You could also have rentals. You could also be like buying and selling other kinds of real property like raw land. It can be many different types of real property trades or businesses. You can have rentals, you can have a hotel, you can have lots of stuff going on. But at least 750 hours during the year have to be in real property trades or businesses. So related to real property, you're renting stuff out, you're selling property, you're doing flips, you're renting farmland. Sometimes that'll happen too. Has to be 750 hours. And then more than one half of the personal services that you're providing during the year have to be in real property trades or businesses. How are you going to prove that when you're working full time at a regular W-2 job? I don't think it's going to happen, right? So my response to this was that they're not going to be able to prove the personal services hourly requirement if they both have full-time jobs in other industries. For real estate professionals, it has to be 750 hours in real property trades. Number two, it's only $13,000 anyway. I mean, compared to their AGI, which is $175,000, I feel like this $13,000 loss is not, they don't lose it, right? It gets carried forward. They're going to be able to use it in a future year when they have actual income from this rental. So, or when they dispose of the rental. So those losses would be released. This is what we say, released, when they actually dispose of the rental in a fully taxable transaction, which means when they sell it to a stranger, not a family member, then they're going to be able to take any losses that were suspended because of their AGI. But it's only $13,000 either way. And marking them as real estate professionals when they don't qualify is going to get them pulled for audit. IRS will audit a taxpayer is if they look at the tax return and they can see this person has a full-time job and they're over 100,000, but they're marking themselves as a real estate professional over one rental. And it's not going to happen. Those two things don't go together. All right. Maybe if I had 10 rentals and I had a little small part-time job, like making $15,000 a year during tax season or something like that, a little part-time tax season job working for a CPA firm, but then the rest of the year I had 10 rentals or 15 rentals, then yeah, maybe I could convince them because more than one half of the personal services that I provide during the year are in real property trades or businesses, and I'm going to be able to meet that 750-hour requirement. Okay, but then remember, none of this really matters. It only matters when people have losses. Because if you have gains, if you have income, what does it matter? You're going to pay tax on it anyway, right? The only time people start to quibble with you about this is exactly this type of a scenario where they've got a ton of money coming in. They're making 150, they're making 200,000 in wages, and they got their little one rental on the side. That rental has losses. And they see those losses on the tax return and they're like, why isn't it like offsetting my wage income? And then you tell them your wage income is too high. You can't take these losses. You got to either have passive income coming in from something else. Wages are not passive income, right? We all know this. Or you got to have your AGI lower, right? It's got to be under 150,000 because the phase out starts at 100,000. Ends at 150, and once you're over 150, regardless of filing status, right? So this is the same AGI limit for every single filing status except MFS, and with MFS, married filing separate, it's even lower. It's half, okay? So the only time you have people arguing with you about this really is this kind of a scenario. When they have losses from their one rental, or maybe they have two, right? And then they got a bunch of money coming in from wages, and they want to offset the wages with the rental loss, and they can't do it because they make too much money. Okay, so they want to be able to say that they're real estate professionals. It's not going to happen. All right, it's not going to fly. They're not going to lose the deduction. It carries over. And when they sell the property, those losses will be released. Or more likely, if they hold on to the property, eventually they're going to start generating revenues, right? Because the expenses go down as it gets paid off. And then the depreciation goes down and the revenue goes up, right? So they'll be able to offset rental income later, in later years. But as of right now, this kind of a scenario, don't mark them as real estate professionals. You know, the fact that the husband is handling the repairs and dealing with the tenants, even if they have a management company, that means that they're actively participating. But it doesn't mean that they're materially participating. So in order to be a real estate professional, you need to meet these two tests. And that's a really hard, bar to meet unless you're doing just real property trades or businesses and that's all you do. Okay. Now I have had family members that met these thresholds and they were not realtors or anything else like that. Okay. My family, is in the Central Valley, and the only family members that all immigrated in the 70s, the only family members that did really, really well, because most of them couldn't speak any English, the only family members that did really, really well are the ones that bought land and houses in the Central Valley. So I have family members that had 8 rentals, 9 rentals, and that's what they did. I have a cousin who he has 8 or 9 rentals and he fixes them up. There's no management company or anything like that. And that's all he does. That's his job. All right. He's not a realtor. He doesn't have any kind of a license or anything else like that. But they're all Schedule E rentals. And he's a real estate professional because that's all he does. Okay. More than 750 hours during the year. He's the one installing the carpet. He's the one fixing the plumbing. He's the one collecting the rents. That's his job. Okay. So all the personal services that he does during the year are from real property trades or businesses. And then, of course, it's more than 750 hours because he does it full time. but then he doesn't have any losses. It's all gains. So it doesn't matter in his case either. But yeah, so these people, you're going to get things like this. And it's always taxpayers like this where they're high AGI and they're making a bunch of money in wages. And they want to try to offset their wages with some small loss from a rental property. This is not going to happen. Don't mark them as real estate professionals if you have a scenario like this. They are not going to qualify. They are not real estate professionals, okay? Now let's talk about real estate professionals and self-employment tax. Now I want you to understand that the classification of real estate professional does not mean that all of your income gets reported on the Schedule C. That's not what it means. A real estate professional can have Schedule C rentals and Schedule C activity. They can be realtors and they can also own rentals that are passive. To be honest, most of the time when I see them, they have a mix of things going on. Really commonplace to actually be a realtor and also have passive rentals and maybe have an Airbnb too and everything. That doesn't mean that all of their activity gets lumped together on a Schedule C. That's not what it means. So the answer is no. It doesn't mean that their rental income is automatically subject to self-employment tax. That's not what it means. The real estate professional designation is useful for two situations. To avoid the net investment income tax, so not just the losses that we were talking about in the last slide, but if you have a real estate professional, they don't get hit with the NIT. And the NIT is terrible. The NIT is terrible. It's one of the ACA taxes, the Affordable Care Act taxes. The other one, remember, we talk about in the webinars, the EA exam webinars. The other one, what's the other one? The additional Medicare tax. So the additional Medicare tax is imposed on active income like wages and self-employment income and commissions and stuff like that. And then the NIT, which is the net investment income tax, is how Congress gets you on the other end. So the NIT applies to investment income. If you have a person who is a real estate professional and actually meets those two tests, that 750-hour test, as well as the 1/2 of personal services test, this is basically their full-time job is dealing with real estate in general, then they get to avoid the NIT, which is great, the net investment income tax that most other rentals are subject to if the taxpayer has a high income. Now, you can also avoid the passive loss limitations where the losses are limited to $25,000 per year. Okay, so for non-real estate pros, that $25,000 is reduced once AGI is above 100,000 and is fully phased out once AGI reaches 150. I think you need to know these thresholds for the test. You need to know about the $25,000 rental loss allowance, and you also need to know about the AGI phase out thresholds for rentals. Here on this slide, and in the IRS publication 527, there's tons of examples in there too, and in the book. Being classified as a real estate professional doesn't mean that all of your income automatically just gets lumped in on a Schedule C. And you don't want to do that, right? Because if you do have a passive rental as well as Schedule C income, why would you want to pay the self-employment tax if you don't have to? You can have a realtor or some other person who's in real property trades or businesses that's not a realtor. Let's say they're a flipper and they're not a realtor, and they have some flips. And they also have rentals, passive rentals, month-to-month rentals. So they can be a real estate professional, but you put the passive rentals on the Schedule E and you put the flip activity on the Schedule C where it belongs, okay? It's all based on the facts and circumstances, but just because a person is a real estate professional and meets those two tests that we were talking about in the last slide, that doesn't mean that all of their income automatically is subject to self-employment tax. That's not what it means. It means they're not going to be subject to the NIT. And it also means that they're not subject to the passive loss limitations that passive real estate activities normally are. Okay, because they qualify themselves as a real estate professional. So they're outside the normal rules. Okay? Conversion to personal use. Okay, the last slide, everyone. How do you report the conversion of a rental property to personal use? The taxpayer was renting 2 of the 3 bedrooms in her home for several years. Now the renters have moved out, so she no longer will be depreciating it. She rented it for only 3 months this year. Okay, so in the current year, she has rental activity, 3 months. So she's going to have a Schedule E for the current year. So for the current year, she's going to claim the income that she made from those 3 months, and then she's going to prorate the deductions based on the number of months that it was a rental. You're either going to have to put that was only a partial rental use in your software, or you're going to have to do it in the spreadsheet to make sure that it doesn't depreciate the rental for the whole year. And also that you don't have like a full year of expenses, because it's not a full year. It's only 3 months. So you're going to prorate the income and the expenses for that short amount of time that was a rental. The next year, you just stop filing the Schedule E. It's just as though like someone had a Schedule C and then they dropped out of that business and they stopped doing business. When you don't have a rental property that is being rented, you just stop filing the Schedule E, but you keep track of the adjusted basis. Because if she starts to rent it out again in a later year, you're going to use the same adjusted basis that you, when you stopped the Schedule E in this current year, you're going to use that same adjusted basis going forward. But you keep track of it. And that's also the adjusted basis that you would use to figure out the gain or loss from the sale when she actually does sell her home at a later date. Okay, so you got to keep track of that. You got to keep it in your work papers or give it to the taxpayer and say, this is important. This is the basis that you're going to use when you actually sell the home, or if you do decide to start renting it again at a later date. Okay, so you just take it out of service, but you keep track of the basis because it's important. Okay, and that's how you do it. The end. That's the end. Make sure to check out our other educational webinars.